7 tips for investing in the stock market for beginners. The most successful investors aren't born overnight. It takes time and patience, as well as trial and error, to learn the ins and outs of the financial world and your personality as an investor. Creating a budget, paying off high-interest bills, and maintaining an emergency fund are all steps towards financial stability. While putting money aside from each monthly paycheck into a savings account will produce interest, there is still a missing piece of the financial puzzle. Investments are where real money is made, but they can be scary due to their complexity. To invest effectively and safely with your hard-earned money, follow these 7 guidelines. Number 1. Set goals. For beginners, you should think long-term rather than fast cash. Investing in the best long-term strategy may not be the most exciting option. However, if you stick with it and don't let your emotions get the best of you, your chances of success should improve. Volatile industries such as the stock market are best for long-term investing because you may be tempted to cash in or out quickly based on your stock's success or failure. First and foremost, a trader must determine whether or not he or she is capable of investing. A person may also have a great desire to invest in the stock market, but if he or she lacks the financial means to do so, nothing will actually happen. Number 2. Know your market. It's been said that knowing half the battle is half the battle, and this is certainly true when it comes to investing in the stock market. Try to learn the general principles of investing by researching and reading about it. The scientific aspect of finance is a good starting point and should not be overlooked. Make certain you understand the ideas involved in stock valuation before moving on to the next phase. This ability will be the foundation of your trading profession. The better at valuing investments you are, the better your portfolio will be. You may also want to reconsider your financial intentions. When it comes to the stock market, it's important to remember that there's always a chance of losing money. Consider how much you're willing to deal with. Number 3. Stock selection. Now that you've learned the fundamentals of stock trading, it's time to choose a stock to invest in. Additional study will be required when selecting a stock to invest in. You may find this tedious, but when you see the profits of your investments, it's all worth it. Traders that focus on locating and best valued equities maximize their capital and expand their opportunities, despite the fact that you should not squander time. A poorly researched investment made in haste typically does not benefit than harm you to your portfolio as well. A trader's defense against high dangers is investment research. Number 4. Create a brokerage account. Some investments can be made without paying a fee and can be done directly with the seller. If you want to acquire assets that don't require a broker, such as typical ETFs and index funds, you'll only need to create an online account to monitor and finance your investment. There are dozens of companies that provide brokerage accounts to people who want to begin investing. Choosing a brokerage firm is an important step in beginning to invest. Each brokerage offers different types of accounts, features, and fees, so you should pick one that meets your requirements. Number 5. Keep costs low. Even if you only have a modest sum of money to deal with, tiny investments can add up to large sums of money. When you first start investing, you should avoid spending significant sums of money even if they're available. Stocks, small mutual funds, and exchange-traded funds are all low-cost, low-risk investment options. Number 6. Choose high or low-risk investments. Once you've gained confidence in your investing talents, it's time to decide whether you're ready for higher risk investments. Great gains, unfortunately, rarely come with some risk. Beginners should avoid anxiety-inducing investments since they will cause you to react emotionally rather than logically in the event of a potential crisis. The majorities of successful investors begin with low-risk, diversified portfolios and learn as they go. As investors gain more experience, they're better equipped to take a more active role in their portfolios. Even if you're investing for a long term with the goal of increasing the value of your portfolio over time, your personal risk tolerance may lead you to less risky investment. Number 7. Consider automation. Certain investments such as a 401k plan or an IRA can be made automatically. Automatic deposits should be made with low-cost funds. Investing that is automated in hands-off can be managed without a lot of effort. You can take a lot more active part in expanding your investing portfolio after you have confidence in your investment techniques. Investing in the stock market can be thrilling, and it's an important part of accumulating wealth. Before you begin investing, make sure you understand how to do it, and that you have thoroughly researched potential investments. You should also think about different investment accounts, like a 401k or an IRA is good investments. Many people could benefit from a taxable brokerage account. Understanding the various types of accounts available to you can help you make the most of every dollar you invest.